if we got 50 basis points, that would be an indication of cuts, I'm saying. Then we would be assuming there's a recession coming along at some stage or the other here as well. But what are you making of the price action on the bond market and what it prices in, and what do you think is going to happen?
Well, Citi actually has a much more hawkish than consensus view on Fed policy. So our thinking is we're going to get, even though there's been some concern about bank turmoil, we're not really getting the credit crunch that people are fearing. There is a slowdown in kind of credit conditions, tightening of credit conditions, but not sufficiently enough. And meanwhile, we expect inflation to be quite persistent. We expect a month-on-month core CPI at 0.435%, and then the next couple of months we'll have a 0.4% month-on-month handle going into the June FOMC. So we actually think the Fed's going to hike 2 more times. We think the Fed's not done until July, so we're a little bit more hawkish. So you can imagine we're definitely going against what the market is pricing in rate cut. We do not expect the Fed is really going to move until next year. And therefore, as they're going to hike further, we're probably going to have, a grind towards a recession by starting, with a contraction in fourth quarter.
Why do you think inflation has remained so sticky? We've seen supply chains are normalizing a little bit now. Energy prices have come down. What's causing the stickiness, you think?
I mean, a lot of it is really driven by the labor market and the tightness of labor market. We did see, right, for example, the April non-farm payroll, it's still pretty decent. We had average hourly earnings running at 0.5% month on month. Now, there are signs that wage growth is slowing, but it's just not slowing fast enough. And the challenge here is, I think, if you just look at the composition of what's driving the economy in the U.S., service sector is still quite resilient. And services sector, like, restaurants, et cetera, they're not as credit intensive. So even if we see a tightening of credit conditions, I think the lags of monetary policy and how that filters into the services sector and the job market and what's driving that persistent inflation, those are some of the reasons why we actually think that core inflation has actually been a bit stickier. The other thing that's been a bit surprising is actually even in the housing, like, for a while we had a little bit of the softening of the rental component of core CPI, but now it's actually rebounding a little bit. So that's, again, further creating some tension. So that just suggests that maybe just the lags of monetary policy is just a lot longer.
How long do you suspect that's going to be? Because things that the labor market's not listening still, not as rate sensitive. Do we need to wait longer than the sort of 18 months sort of?
So I think that's the thinking. Like, you can make an argument. I mean, with policy rate Fed funds 5.25, this is already arguably restrictive. But then the question is, does the Fed have to take it even more restrictive? So as I said, we expect they're going to have to hike until July.
Yeah.
And then we will start seeing hopefully more traction of a slowdown. And the recession is unfortunately the necessary byproduct to bring inflation down towards the 3%. So therefore, we don't expect the Fed to cut maybe until basically first quarter of 2024.